Hey, good morning, everyone. Marty Missouri here. It is the 2nd of October, 2019, Wednesday morning, just a bit after the open. Well, actually, 49 minutes after the open, to be exact. In front of you is a real zeroed in on daily chart of the S&P 500. Not going to take much of your time this morning. A lot going on in the world, a lot of action in the markets, as you've no doubt noticed. And of course, I will have more for you on the written blog. I should tell you, I am working remotely this week, so may not get quite as much information from me on the blog, but plenty for sure, if not even the normal amount. But I did want to just take a couple minutes right now and update you on what's going on technically in the markets. So in Saturday's video, we were looking actually at the S&P futures chart. This is actually the S&P cash index that trades during the day. And as you may recall, if you're with me on that, futures actually came down and tested this resistance line from that long consolidation that we ultimately broke out of. And I said this no doubt was going to be strong resistance. And I said, look for a pop on Monday or early this week to be exact. And I said, look for it based on Washington walking back the commentary on Friday that inspired this big dip. And it didn't even take till Monday. Sunday, they said that they were not considering right now delisting Chinese companies. Actually, a memo has popped up since then that actually suggests that they were considering that. But as I said on the video, that would be so destructive as it relates to the market that at this juncture, they're not going to go there. So in the cash index, though, yesterday we actually did do it officially. We came down and came down hard, and that was just like a rock. It came down, hit that resistance level right there that was resistance, that was pretty strong support yesterday. If I show you the minute or the hourly chart, it just danced there all day. Problem is that while it bounced a bit off and on, it really didn't get anything substantial. I was looking for something more substantial to the upside. Of course, the timing here, hitting this level and then losing it once again at that resistance that is growing pretty strong here. It actually coincided with the Institute for Supply Management manufacturing survey, which I did touch on in the written blog yesterday, coming in really weak. Today we got ADP private payrolls number, 135,000, 150 was expected. And that doesn't necessarily bode well for Friday's BLS number, Bureau of Labor Statistics, and that's the one, of course, everybody watches. Before we get there, though, tomorrow we're going to get the ISM Services Survey, and it's actually expected to come in at a strong 55.5. If it disappoints like the manufacturing survey did, boy, this could get really ugly in a hurry. One thing that we should definitely note is that bad news is now bad news. Remember, for quite some time there, bad news was good news for stocks because when we get a bad headline relative to the economy, then it would suggest the Fed's going to come in and be aggressive and stimulate. Well, the Fed is now back in stimulus mode. That's very clear. They may step up the rate at which they lower interest rates. But I think what the market is finally telling us is what I've been saying for months and months, if not the last year plus. And that is that when we're talking about a world of amazingly low interest rates already, a bulging corporate debt scenario, essentially a lot of borrowing already going on within the economy, lowering rates even further, while it did spark huge refinances in this week's data. Not much in terms of new purchase applications week over week, but a 14% increase in refinances. But in terms of new borrowing to inspire capital investment on the part of businesses, that's not happening. A lot of borrowings going on for share buybacks, for retiring old debt, and so forth, but nothing that's really expansive and nothing that should really make us feel good about anything other than manufactured earnings per share. And that ultimately just doesn't make for a good long-term thesis, frankly. So, folks, what I'm here to tell you is that we are now breaking below some technical levels here. You see how we gapped here? There were no doubt A lot of stop losses that got hit here this morning, and that just got exacerbated. 2,900 right here, if you see this candle, is where the market is bouncing against. We break through that, then we've got this trend line to contend with, but it's not looking good right now. I can see a couple of catalysts. Could be commentary out of Washington, a real positive tweet on trade, or something out of China. That could send the market rocketing higher. Right now, though, we're back in that August range. This right now, by definition, is a failed bullish breakout, and that's not a good thing technically. Take my word for it. We come down and penetrate these lower August support levels, and it could get pretty ugly on the downside. Remember, folks, this has actually been my base case for quite some time, although I did expect that it would come after one more marginal new high, which we still may get. So I'm not saying this is the beginning of the next great correction or the next big bear market. When we get there, when it begins, of course, this is how it's going to begin looking. And we're going to have big down days, and we're going to get these bounces and so forth. My big concern is the big picture. What's the macro look like? As I've been illustrating for you, it's not looking good under the surface. The consumer's been holding up, but the rest of it really hasn't. The technicals, as I'm showing you, the long-term bearish divergences and the momentum indicators and so on, just aren't looking good. The term I've used lately is this market's looking real heavy to me on a longer-term basis. Right now, it's looking heavy even on a short-term basis. I still think we should expect big volatility in both directions. My bias is based on probabilities as I see them today. And that would suggest that the next big move in the market is more likely to be down. And then, as I've illustrated for you before, we get down into a contracting economy, and we've got some real serious issues under the surface, particularly in the corporate debt arena, to contend with. So stay tuned, and I will keep you posted, and we'll continue to act accordingly within client portfolios. Thanks as always for watching and listening. Talk to you again very soon. Bye-bye.